Warren Buffett described Microsoft as one of his dream businesses. But why? It's not for the reasons that you might think. Even though it's unlikely Buffett would ever buy Microsoft himself due to his friendship with Bill Gates and not wanting to send the wrong message, Warren Buffett still says Microsoft is a wonderful business. Microsoft is a company that has an ever-increasing stream of earnings with virtually no major capital requirements. But just because Microsoft is a wonderful business doesn't mean you can pay any price in the world for it. We're analyzing Microsoft, stock ticker MSFT, to see if its market price is a fair value for the quality of the business you'd be getting. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Microsoft. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Microsoft for your portfolio. Before we get into these valuable metrics, let's understand Microsoft's stock performance. Right now, Microsoft trades for $333.67 per share. Year to date, their stock price is up 40%. Microsoft is one of the 7 large tech companies currently leading the charge on the S&P 500. In the last 5 years, Microsoft's stock price is up 27% compounded annually. Their drawdown in spring of 2020 just looks like a blip on this graph. In the last 10 years, Microsoft's also compounding at 25% annually. Going back prior to the global financial crisis, in the last 18 years, Microsoft's compounding its stock price at 15% annually. Even though they were a large company at the start of this time, Microsoft's still one of the top performing businesses over this 2-decade period. Microsoft trades just $5 below their 52-week high. The company's up $120 from their 52-week low. Less than 0.5% of their shares are sold short. Microsoft has a $2.5 trillion market cap. They're one of the largest businesses in the world, hands down. Microsoft also pays a 0.7% dividend yield, which would be in addition to their compounded annual returns. But the burning question is, Warren Buffett said Microsoft was a great business in 2007. With the rise of artificial intelligence and cloud computing, is that still true 16 years later? Microsoft develops and licenses consumer and enterprise software. It's known for its Windows operating system and Office productivity suite. The company is organized into 3 equally sized broad segments: productivity and business processes, which include legacy Microsoft Office, cloud-based Office 365, Exchange, SharePoint, Skype, LinkedIn, and Dynamics; Intelligence Cloud, which includes their infrastructure and platform as a service offerings through Azure, Windows Server OS, and SQL Server; and more personal computing, which includes Windows Client, Xbox, Bing Search, display advertising, and Surface laptops, tablets, and desktops. Microsoft also owns a stake in OpenAI, and ChatGPT was built and trained on Azure services. Starting with metric number 1, we want Microsoft's average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. These business returns are captured by return on capital. The average publicly listed business only earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in some margin of safety. Microsoft has been crushing the average company over this time. Their returns on capital were above 20% in 2018, and they've steadily grown in all 5 of these years. In their most recent fiscal year, Microsoft earned 34% returns on capital. Averaged out over this time, they're earning 27% returns on capital. That's nearly 4 times better than a typical business. This is a big check on metric number 1. Metric number 2, we're looking at their growth. We want to see 5-year growth in their revenues, net incomes, and free cash flows. This is all or nothing. All 3 have to be up for this to be a check. In the last 5 years alone, coming off of a huge revenue base of $110 billion a year, Microsoft's grown their revenues by 88%. Their earnings have quadrupled over this time, in part to 2018 being a low earnings year for the company due to a very large income tax expense. Microsoft's free cash flows have also grown by 78%. This is big growth across the board for all 3 of these. Another huge check on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years for Microsoft. As their earnings have quadrupled over this time, their earnings per share are actually growing faster than this. This is because Microsoft's bought back a slight amount of their shares outstanding, repurchasing around 4% of their shares, likely a good sign for long-term shareholders in the business. This is another check here on metric number 3. Metric number 4, here we're looking for free cash flow per share growth in the last 5 years. Again, because of strong growth in their free cash flows and slight share buybacks, this is another check on metric number 4. We're perfect through our first 4 metrics on Microsoft. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Microsoft apart, which is having this big growth and strong returns without using a lot of debt. Metric number 5, we want Microsoft's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in their last 5 years. Microsoft has had negative net debt in all 5 of these years. The company ended their most recent fiscal year with $26 billion left over in cash after paying off their debt. Right now they have $25 billion left in cash. And over this time, Microsoft has produced $237 billion. There aren't many companies in the world with that big of a market cap, let alone throwing off these kind of cash flow numbers. This is a massive check on metric number 5 for Microsoft. They're one of the most cash generative businesses in the world, hands down. Still perfect through 5 metrics, does Microsoft have what it takes to go a perfect 6 for 6 and be a select 6 stock? Before we find out, it's time for our bonus. As our bonus, we're looking at Microsoft's dividend profile. Right now, Microsoft pays a 0.7% dividend yield. They've grown their dividends in all 5 of these years, and we want to see that it's supported by their free cash flows. That's easily been the case in all 5 years. As they've grown this dividend, Microsoft has grown their free cash flows per share even faster. Their dividend payouts seem to be very healthy and supported by their free cash flows. This is another check on our bonus. While this is a snapshot of their last 5 years and no guarantee for the future, it seems like Microsoft could be a dividend growth stock and potentially a future dividend aristocrat or a dividend king. Ultimately, time will tell. Does Microsoft have what it takes to be perfect on our analysis? The big metric of them all, metric number 6, we want Microsoft's average free cash flow to their enterprise value to give us a yield that's above 5%. If this is the case, this will give a slight risk premium to the yield of the 10-year treasury, and it may offer a starting point for a valuation of Microsoft. We learned in their last 5 years that Microsoft has produced $237 billion worth of free cash flow, meaning they produced $47 billion of free cash flow in an average year. Right now, Microsoft nearly has a $2.5 trillion enterprise value, which factors in both their debt and their market cap. When we divide their $47 billion of their average free cash flow by their $2.5 trillion enterprise value, that only gives a 1.9% average free cash flow to enterprise value yield for the company. On a current basis, Microsoft produced $57 billion worth of free cash flow in their last 12 months. When that's divided by their enterprise value, we get about a 2.3% current free cash flow to enterprise value yield. Both of those are coming in below both that risk premium and the yield of the 10-year treasury. All the way at the end here, this is our first and only X of the day on Microsoft, but don't throw Microsoft out. Let's get a more concrete estimate of a fair per share value of Microsoft. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Microsoft, which takes us on to using a discounted cash flow model to come to an estimate of their fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with Microsoft's current free cash flows and using historical assumptions to grow these into the future. It's up to you to do your own homework to figure out if these are accurate and applicable going forward for Microsoft. Assuming Microsoft grows their free cash flows at 11% annually for the next decade. Then in the 10 years out from there, this growth rate would be cut in half. If we add in Microsoft's tangible book value, which gives an estimate of their net worth, and if we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, in addition to his margin of safety requirements, right now at today's valuations, it looks like a fair value for Microsoft is around $114 per share. That's down more than $200 from their current stock price. Now, there are reasons why this may not be accurate for the business, so don't take this to the bank as financial advice. It's not meant as a buy or sell recommendation. Microsoft's been a relatively predictable company in its past that might not be a guarantee for the future. Also, at different times in their history, Microsoft has grown a lot faster than this. Their terminal growth rates could be even stronger. Lastly, due to how the accounting works for their share buybacks, there are reasons why this tangible book value may be understated for Microsoft. As always, consult with a financial advisor before making any investment decision. In just a minute, we'll give our final rating to Microsoft, but we have to address something first. We've covered the numbers, so we've done the work on the quantitative. But Warren Buffett gives strong consideration to the qualitative. So what are those aspects for Microsoft? Starting with the qualitative factors supporting a potential long thesis. Number 1, Microsoft has monopoly-like positions in various areas, including operating systems and their Office products that serve as cash cows to help drive Azure growth. Number 2, shift to subscriptions accelerates growth after the initial growth pressure, and the company has passed the margin inflection point now such that margins are increasing again and have returned to pre-Nokia and pre-cloud levels. Number 3, public cloud is widely considered to be the future of enterprise computing, and Azure is a leading service that benefits the evolution first to hybrid environments and then ultimately to public cloud environments. Then the qualitative points supporting a potential short thesis. Number 1, Microsoft is not the top player in its key sources of growth, notably Azure and Dynamics. Number 2, Microsoft continues to lack a meaningful mobile presence. Number 3, momentum is slowing in the ongoing shift to subscriptions, particularly in Office, which is generally considered a mature product. There you have it for a balanced perspective of some of the qualitative aspects of Microsoft. Now it's time to give our final rating. In analyzing Microsoft, stock ticker MSFT, we were trying to figure out if Microsoft's still a wonderful business 16 years after Warren Buffett said it was. With the company's innovations in cloud computing and artificial intelligence, it seems like Microsoft is still there on the technology front, and from our analysis of their finances, it looks like their numbers are backing that up as well. Microsoft earns huge returns on capital, they've grown strongly in the last 5 years, they've even bought back some shares, and they're sitting on $25 billion in cash, while being massively cash flow generative. They've also paid out a growing dividend and still fueled the company's internal growth. The only slight in Microsoft's numbers came in their valuation. When we're looking at a yield of Microsoft's average and current free cash flows to their enterprise value, those were coming in below the yield of the 10-year treasury. And when we performed our discounted cash flow analysis, that was coming in hundreds of dollars below their current stock price. In fact, you'd have to go back 4 years to March of 2019 to see the last time that Microsoft traded at those levels. While Microsoft's stock has performed better than that since then, there may be good reason that their valuation could be stretched. It's worth reiterating this is not financial advice. When we combine the factors of our analysis, Microsoft still looks like a wonderful business today, especially with their grip on business software and with the rise of artificial intelligence. Microsoft seems to have an exceptional business that pretty much has bundling and cloning in their DNA. They're a very strong candidate for further research. You ultimately want to find a valuation that you'd be comfortable with for Microsoft as a business. Before considering any investment decision, consult with your financial advisor. This is not a buy or sell recommendation of any security. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more analysis videos. Let me know what business you want me to look at in the comments below. Thanks for learning about Microsoft with me, and have a great day.